Well, thank you everyone for tuning in. This is our drill number 3 of Options Bootcamp. And I know this is our holiday season and holiday week. So I really appreciate you guys still tuning in to understand what options is. Um, Very humbling experience for me. So this will be the last drill for this year. Don't want you to engage you in the next week when we are in the middle of Christmas and New Year. That's a time to spend with family, relax, little enjoy, and take your time, and mind off anything related to trading or learning, options. So we'll come back in 2021. So this is our last drill for year 2020. So with that, if even I won't be having my Saturday regular session this year, so wish you all happy New Year because we won't be meeting again. And let's get into today's session. Okay, so today's drill number 3, we're going to talk about the concept of moneyness, in the money, at the money, out of money. And then I'll also want to take you through the overall process of option exercise assignment and the concepts behind the delivery. So that's the topic for today. Before we begin, please note this is not an investment, financial, or tax advice. This is all for education purposes and maybe a little bit of an entertainment, but don't take it as a professional advice. We are here to learn from each other. I share my experience, what I have been doing in options, and if you feel like, maybe learn from there. And before you do any trades or make a big decisions in your portfolio, consult your professionals. Yeah. All right, I see a lot of new names in here. So a little bit about myself. Many of you already know me. You've been attending the Saturday session. Some of you have known me for more than a decade. We are family friends, and some of you have been my colleagues for more than 2 decades. So yes, I've been working in the software industry for 2 decades, mostly in the fintech and data management space. 15 years in investing. Started as like any regular in I would say a working guy or girl who has a full-time job and but still wants to earn something on the sidelines through investing. That's how I started more than 15 years ago, starting with stocks and ETF, but being active in options for more than 4 years now, almost close to 5 years. Our philosophy is to think risk before the rewards. Rewards look very juicy, but in many times we forget about what the risk we are taking. So you won't see me taking undue risk. I don't want something which is a side gig to overcome me and disturb me and not let me sleep well in the night. We don't want to do that. We already got our tensions from our work and our job. We don't want another stock tension to keep us awake. I am located in San Jose, California. If you want to know more details of how I got my start, go back and watch session number 1, drill number 1, in which I talk a little more details about what was my trigger point to get into options. Okay. But if you want to stay in touch with me outside of this boot camp, I also have a podcast wherein I share my thoughts. Got a YouTube where you'll see some recordings or um, some analysis, etc., which I put in. Or you can go to my website, email me. Email is fine as well. And sometimes I'm active on Quora, especially in the options trading topic. I'm pretty active over there. And lastly, ping me on Twitter if you want to connect with me. Let me just put the links for these in chat so you can get access to it. And if you fancy connecting with me outside of these sessions, you could do that through these other channels. All right, a quick overview of boot camp. We are already done with these topics. Today we're going to talk about moneyness and option exercise assignment. Then we'll dive into the small account trading strategies, how to use those if the account is small. Then we'll talk about the checklist of opening an option trade. What is a checklist that you should run through before you open an option trade? Getting into a little more complex ones, which are the multi-leg option strategies. Then we start getting into a little more advanced topics of understanding how the options are being priced, and how that pricing could affect the trades that we make. Then getting into the trade management techniques. While we take every precaution when we initiate a trade, things could change. But options do provide us options to manage it if things go wrong. So we're going to talk about 4 techniques of how to manage options that have gone a little haywire. Then we get a little more details into option Greeks, and I will only focus to the extent which is required for retail traders. I'm going to look at the first order Greeks, delta, theta, vega, and gamma. We're not going to look into the second order Greeks like Voma, etc. That's not needed for us. Those are required by market makers, but we don't need to get into those details. We're going to talk about what's the best criteria to exit an option trade. So we go through the checklist. We'll then get into the risk management using options. Because along with an options, I'm sure all of you would have either some long stock portfolio or your 401ks, IRAs. So how to use options to do risk management across your portfolio. And then lastly, we look at if you have options portfolio, how to manage it like a pro. What are the things that we need to take care of? And then the final topic is something that you won't find in any options book, is if you are just part-time option investor. That's how I got my start. I've been doing it for 4 years along with the job. There are some things that tips and tricks that worked out for me. We'll share in the end. So that's the overview of full boot camp. We have already done 2 drills in which we had covered. If you had missed those sessions, the first 2 drills, you can go to the website or OptionGig.com, register as a user, and go to menus of go to the one side. Let me go back a little bit, confusion on the slide. Yeah, you can register as a member, go to members, go to bootcamp, and you should see the recording updated over there. So we got the 2 drills out here, and the third one would be uploaded in a couple of days. Yeah. So that's all about the sessions in the previous ones. So if you have any questions on what we have already talked about, do let me know right now. Or any other questions in terms of how to access, or if you are here for the first time, if you have any beginner questions, do let me know. Otherwise, we will begin today's topics. Okay, so let's jump into the topic for today. And half an hour before our time, I was going through all the topics, and then I realized maybe I should cover one more, which is called the wheel. Because we talked about cash secured put, we talked about covered call, and I think this is an appropriate time to talk about a strategy. It's not really a strategy, but I would say a process that many option traders use, which is called the wheeling process. Okay. So I sneaked in this topic like 30 minutes before the start of the session, and then we'll go through moneyness and options expiration and assignment, and we'll have a break for Q&A in between these sessions. So before I start, any questions right now? Oh, all good. That's good to know. Okay, so let's get into the first one, which is the wheel. So what's a wheel strategy? And this is a common word among the lingo of option investors or option traders. So the way wheeling works is, first step is a share acquisition. I am bullish about a share. I want to have those shares in my portfolio. We got two choices. One is go ahead and buy the share upfront from the market, or you can sell a cash secured put at whatever strike price you're okay to buy the shares. If you're okay to buy the shares at current price, sell and add the money cash secured put. If you want to buy the shares at lower than the market price, go and sell a put at a strike price which is lower than the market price. Whatever price at which you are okay to hold those shares. So first is that's a share acquisition step. When we talked about cash secured put, I mentioned this is if you're moving from stock, purely a stock investor, to an options, maybe use this cash secured put as your share acquisition step. So in your wheel strategy, that's your number one step. So you go ahead and sell a cash secured put. What could happen? Put may not be assigned, means the stock did not go below your strike price. In that case, you will not be assigned the shares, but you had retained the premium. So when you sell that cash, when you sell the put, you get a premium upfront. We had a question in the quiz that if you sell a put at 45, you got a premium of $3. Now at expiration, the stock is still above 45. So you will not get the shares. So that put will not be assigned to you. In that case, you will still retain those $300. Those are yours to keep. If that happens, repeat the step. So you can keep selling a put for every expiration. Say if you are sold it for January 2021 monthly expiration, and on January 15th, the stock is still above 45, don't get assigned, go ahead and on next trading day, go ahead and sell it for February. Okay. So if your put doesn't get assigned, keep retaining the premium and keep repeating the step. If your put get assigned, then you have to buy the shares at the strike price. Let's say the question get an example of 45. So in those cases, you will have shares in your portfolio at $45. You have to buy those at $45. So now what do? You got a shares in your portfolio, you acquired the shares. Now you have to look at, okay, I want to sell those shares. Either you can sell it at a market price right now, or you can put a limit price which is a little higher than market price because you want to sell it a little higher than the market price. But then you don't get paid for waiting. Or you can sell a covered call. So the step 2 of this wheel is go ahead and sell a covered call. Now coming back to our example, you sold a put at 45, January didn't get assigned, you retained the premium. You sold a put for February, didn't get assigned, you retained the premium. Then you sold a put for March expiration, so you got assigned. Now you have 100 shares of that XYZ stock in your portfolio. Now you go ahead and sell a call against those shares. That's why it becomes covered call. You go and sell a call against those shares for April expiration. What could happen in April? Your call may not be assigned because the shares never went above your strike price. So you still retain the shares in your portfolio, and you also retain the premium that you collected when you sold the call. So you still have the shares and you also have the premium. So essentially, you got paid for waiting for stock to go beyond your price, which is your strike price at expiration. So if call is not assigned in April, you repeat it because you still have the stocks or the shares in your portfolio and you got the premium which brought down your cost basis. You repeat the step. Do it for May month. Do it for June month. Say if your call get assigned in June. In that case, the shares will be taken away from you at the strike price. So now your portfolio does not have any shares. So you had XYZ shares because you were assigned those shares. Now in June, the covered call got assigned. So those shares, XYZ shares, 100 shares of XYZ has been taken away from you. Your portfolio have 0 shares of XYZ now. Now you can think, are you still bullish on the stock and you want to get engaged in the stock or not? So if you're not bullish on the stock, you don't want to acquire the stock again, stop right here. Or find another stock, find ABC stock. But if you are still bullish on the stock and continue want to play this, just rinse and repeat the same process. Now this is one variation of a very basic variation of wheeling. Now as you get more experienced, or if you are more bullish on it, you can make changes to some of those steps. For example, if I am really very bullish on XYZ and I want to acquire 200 shares, but I might sell just one cash secured put here. Once I get shares assigned, I might sell a put as well as a call here, essentially strangle, right? So there are variations that you can do, but this is a very basic wheeling process. And you will see me talking about, hey, if I get a shares, I'm going to wheel it to reduce my cost basis until it gets called away. And then I'll see if I'm still interested in it. I'll rinse and repeat the same process. So this is in a nutshell what's termed as a wheel strategy. Again, this is not an official term. So you may not see it in any books if you're looking at option trading strategies, but this is pretty common way I see many option traders using it to get a share and then continue collect a premium until it's called away. If it's called away, still bullish on it, rinse and repeat. Right. Let me see if there are any questions. Okay, so I'll come back to some of these questions. Those are outside of the wheeling. So yes, question is, do you mean every month we are writing a cash covered call? So every month, so I believe you're talking about step number 2, where we do a covered call. So because you have a shares already in your portfolio, you do a covered call, and at an expiration, end of expiration, if the stock has not reached your strike price, you will still have the covered call. You still have the shares in your portfolio. Go and do a covered call for the next expiration month again. So yes, you will do it for every expiration month after month until that stock is called away from you. So generally, I prefer around 45 days to expiration, but 30 days is also fine. I don't like doing anything below 20 days to expiration. So my general feedback would be, let's say between 60 days to 30 days is a right time frame to write a covered call. So if you're doing month over month, if it's not exactly 30 days, do 40 days, 45 days, that's fine as well. Why? There's a whole detailed study that I can cover later on in terms of how the option premium decay happens. And from 45 days is that's where we start getting the maximum theta decay. That's the reason. Prior to that, the decay in option premium is at a slower pace. Less than 20 days, the decay is faster, but so is the gamma risk. So because we haven't talked about option Greeks, I don't want to get into theta decays and the gamma risk right now. So stay with me. We will cover these questions in the bootcamp. There are a lot of things to talk about in options, and I don't want to jam everything in the beginner sessions because then you'll be wondering, what is this theta? What is this gamma? So we will cover it when we'll talk about option Greeks and how those Greeks impact the option pricing, how those Greeks behave as in their option expiration period. So 45 days, why I'm saying is because the decay, theta decay starts to accelerate after 45 days. It is maximum closer to expiration, but so is the gamma risk. So we'll get into those later. So hold on your questions around that. But for now, if you're trying to sell covered call, the best is sell closer to 45 days, but it'll be still okay if you sell it, 50 days or sell it 30 days. Just don't go and sell at 2 weeks away covered call. Okay, I see. Question, do you take into account IV rank to think about which stocks to option? So we will cover this when I'll talk about option entry criteria. It's not, IV rank is one big factor because it allows to get a lot more premium, but there are also other factors uh, that I consider before opening an option trade. So when we'll talk about option trade entry checklist, that's time I'll cover all the criteria. And again, those are criteria. I use it if I have to do only the option trade. I have no intention of acquiring the shares, right? So that time I'm behaving purely as an option trader. Whatever we are talking right now is kind of a baby steps from being a stock trader. You are still doing the things as if you are a stock a trader, means you will still acquire shares. Right now we're just looking at what's a better way to acquire shares. Should I put a limit order? Should I just go and buy the shares, or should I sell a cash secured put? So once we start to transition from being only a stockholder to an option trader, that then we will talk about what other criteria like IV ranks, you look at your, how your portfolio is diversified, etc., etc. Yes, then we will talk about IV and IV ranks. Okay, looks like no more questions on this one. So let's move on to our next topic, which is moneyness of an option contract. And now, the reason I want to cover this right now is if you're in options business, you will hear these terms, right? In the money, at the money, out of money. So what I want to talk about it, what do these things mean? And as an option seller, what is good for us, what is not good for us. So let's dive into moneyness of an option contract. I want to talk about what is moneyness, what is moneyness of a put option, how it changes, moneyness on a call option, then how does the state of moneyness impact option buyer or option seller differently, and then finally we'll end with the takeaways. So let's look at moneyness. Now the state of moneyness of an option contract tells if the option contract is profitable. Okay. It doesn't consider the impact of premium. And it is looked from the perspective of buyer of option contract. Means how the option contract currently impacts the buyer. Right? Is it profitable for the buyer of option contract or not? Now, I am mostly option seller. So for me, it would be a reverse. But the industry standard, when we're talking about in the money, out of money, ATM, it is generally viewed if the contract is profitable for option buyer or not. So we'll go through what these things mean. So there are three flavors of moneyness of option contract. One, first is called in the money. In the money means the contract, the option contract, it is profitable. It is making money. It is in the money. But remember, it is profitable for whom? It is viewed from the perspective of option buyer. So it means the contract, the option contract is profitable for the option buyer. In that case, we will say that this option is currently in the money. Out of money means it is in loss for the option buyer. And at the money means it is neither making profit nor making any loss. So it is a break-even point for someone who has bought an option contract. Again, it doesn't consider the premium. So we'll take some examples so that it is clear. So let's talk about put option contract and see how its moneyness changes. So when you have a put option contract, it is in the money if the stock price is less than the strike price. Now think for a second. From a perspective of buyer of put option contract, why would someone buy a put option contract? And what does that put option contract gives to that buyer? So if we go back and recall bootcamp session number 1, the put option contract gives the buyer of the contract a right to put the stock or to sell the stock at the strike price on or before the expiration period. So if someone has bought a put option contract, that person has a right to sell the stock at the strike price. So let's take an example. My favorite stock, XYZ. I am an option contract buyer. This is an example word, so I can become an option buyer. So I'm an option contract buyer. I bought a put option for XYZ stock at a strike price of 50. That gives me a right to sell the stock XYZ at $50. Now, when this option contract become meaningful for me, if the market price of the XYZ is below 50. If the XYZ is trading in market at 55, then I won't use my put option contract. I won't exercise my right to sell it at 50. Why would I? I would rather sell my shares at 55 in the market, in the open market, and won't worry about the put option contract. But if in the market the stock price is at 45, now this option contract is valuable for me because I have the right written on an option contract that I have a right. Vivek can sell XYZ stock at $50 and nobody can take away that right from me. I don't care where the stock price is. If stock is 45, fine, good. If a stock is 30, now that option contract is a lot more valuable for me because now I can sell it at 50 even if the stock price in the market is $30. So the moment the stock price goes below my strike price, which is the moment the stock goes below $50, this option contract starts to make money for me. Again, we are not considering the impact of the premium. In real life, you will see that you do need to, but I'm just explaining it from the why this term ITM comes into picture. Why it is in the money, because now the contract is making money for me, that the stock in the XYZ price is now $49 in the market, but I can still sell it for $50. So now that makes sense for me. Now that option contract is useful for me. So that's why if the stock price falls below the strike price, a put option contract becomes in the money. Hopefully that makes sense. So out of money, if I bought a put option contract, it's not useful for me if the stock price stays above the strike price. We took an example of if in the market the stock is trading at 55, hell, I won't even use my put option contract. I'll forget about it. Because if I were to sell the shares, I'll go and sell the shares at 55 in the market. Why would I make use of this option contract to sell it at 50 when I can sell the same shares at 55 in the market? Remember, I have a right to exercise. I may choose not to exercise it. So if it is out of money or out the money or OTM, then I will not exercise my right on this contract. This contract will expire worthless. At the money is when the stock price is exactly equal to the strike price. Rarely happens. Rarely means that it is still possible that it may happen, right? But if the stock price is exactly equal to strike price, then this option contract is not making any money for me, nor I'm losing anything. You know, whether I use this option contract to sell it at 45, sell it at 50 by exercising my option contract or by exercising my put option, or I can sell it at 50 in the open market. Doesn't really matter. So this option contract is neither making money for me, nor it is out of money for me. So that's why it is called at the money. So this is how it will be represented on a strike price timeline. So if you will look at it, at the bottom we have a strike price. The moment, sorry, at the bottom we have a stock price. The moment stock price is higher than your strike price, it is out of money. If a stock price is lower than the strike price, this put option contract is valuable. And we will start to thank our stars, good that I bought this put option contract. Yeah, I'm not suggesting that you should go and buy, but we want to understand how this terminology start to make sense. And this terminology, when we are looking at it, we have to think from a perspective of buyer of option contract. So if we are selling it, flip everything. If it is in the money, it is not good for me as an option seller. Because again, option seller and option buyer are the two sides or the two players of the option contract. If it is profitable for option buyer, then it is not profitable for me as an option seller. So we'll flip everything. Okay. Let's see. Why premium is not considered in the chart? It is just because if you look at the terminology, you will see it says in the money. Then it means it falls below your strike price. But that is why it is not considered. It doesn't consider the premium because that is already, paid off. That's like water under the bridge. So I'm just trying to explain how to view these terminologies. The overall trade may not be profitable because depending on how much of premium you have paid, right? But this option contract is in the money, that doesn't mean that as an option buyer, you owe a net you are about to make money. Okay, so there is a difference because you paid a price to enter into this option contract. So even if stock has cooperated, even if the contract is in the money, your overall situation may not still be profitable. So these are two separate things. Right now we're talking about in the money of the option contract, not if your overall portfolio is profitable or not. So for example, this is how your profit and loss diagram for a put option contract is, right? So if it is stock price, so in this case, you have sold or you bought a put option contract at $27, right? You paid a premium of $1.50. So the put option contract is still in the money anytime the stock goes below 27. And but if it is not profitable because you paid money to get into this, so it starts to become profitable only after the stock has fallen below 25 and a half. So this is the overall P&L diagram of your put option. But if you're just looking from a contract perspective, it is in the money the moment it goes below your strike price. Okay. Okay, let's look at a call option contract. Um, so I see another comment says buy stock at low price. Sorry, I didn't get that. What is it related to? Okay, all right, I'll disregard. Now let's talk about the call option contract and how its moneyness behaves. So call option contract, it is in the money if the stock price is higher than the strike price. Again, view it from the perspective of call option buyer. Session number 2, call option. What does a call option buyer gets? The buyer of the call option has a right to call the shares, i.e. to buy the shares at the strike price on or before the expiration period. Favorite ticker XYZ, strike price 50. If I am the buyer of that call option, I have a right to call the shares or to buy the shares at $50, irrespective of where the share is trading in the market. Now, if the share XYZ is trading at $60 in the market, this is a very valuable option contract for me because I have a right to buy it at 50. So what I'm gonna do, I'll buy it at 50, sell it in the market at 60. If it has 80, it is even more valuable than me. For me, I'll buy it at 50 because I hold this call option contract, which gives me a right to buy the stock at $50, irrespective of wherever it is in the market. So I'll buy it at 50, sell it at 80. So if it has 51, I will still exercise this because I can still buy it at 50, sell it at 51. I'll make $1. So if the stock price in the market is higher than the strike price, it is called in the money. Reverse is out of the money if the stock price is less than the strike price. So if in the market it is trading at 49, why the hell will I go and exercise my call option to buy the shares at 50? I would be fool. I would rather disregard my call option contract and go and buy the shares from the market. It is trading cheaper in the market. I'll buy it at a lower price from the market straight away at 49. So if the stock is less than the strike price, then this option contract is not of value for me. It's a piece of paper. Okay, nowadays we don't have a papers because it's all electronic, but you get the point. It's it's a piece of paper that is worthless. At the money, it's neither making profits for me, it's not making any losses for me. It is break-even point. It means, in our example, the stock is exactly at $50, which is what my strike price is. So that means it is at the money. So we talked about put option contract. Now in the call option contract, just flip it around. If a stock price is higher than the strike price, it is in the money because I can still buy the shares at this price. So if the stock is trading at here, I have a deep profit margin. So here, allow me to introduce one more term, and which you should see me chatting, is it's deep in the money, right? Deep in the money means if the stock is way higher than my strike price. If it is just stock is just here, it is, yeah, slightly in the money. It is slightly more in the money, slightly more in the money. Now it is deep in the money. Same is the case with the put option. So as it gets further away, it becomes deep in the money. But if it is stock is less than the strike price, then it is out of money. And same, if it goes further less, it is deep out of money. Okay. Any questions on call option contract and how it's ITM? So we will talk about intrinsic and extrinsic value when we will discuss the option pricing and the components. And then we will talk about at expiration, in the money has got only intrinsic value, out of money has got only time value left. So I don't want to introduce those two terms right now unless we have talked about the option pricing and its components, because the next question will be, what is intrinsic value? What is extrinsic value? How do you find that? That's a separate session in itself. That is why I'm not just linked it to intrinsic and extrinsic. Okay, what should be the strategy if you are deep in the money well before expiration? Again, there depends on what's your what's your option trade. If you have sold a call option or if you have sold a put option, and now how deep in the money is it? How far away from the expiration date is it? Depending on that, there will be different, I would say, outcomes which will be beneficial. So again, I'm not going to talk about those right here. Right now, I just want to introduce the concept of in the money, out of money, at the money. Once we do this, once we understand how option pricing works, once we understand how the intrinsic and extrinsic premium or the extrinsic value in options work, we can talk about a little more details around option strategies. Okay, similarly, moneyness of these option contracts, if it's 29 call, but in any case, so this is your long call, means you bought a call at a strike price of 29, you paid a premium of 80 cents out here. So even though your contract is in the money, you're not making any money until the stock goes above your strike price plus the premium paid. Few points to think about on moneyness. That moneyness is of option contract is not constant. Why it is not constant? Because moneyness is derived by the relationship between the strike price and the stock price. Now, strike price is constant. Once you have entered into that option contract, you can't change that option contract until expiration, right? For the lifetime of that option contract, that strike price is constant. What keeps changing is the stock price. It changes with every tick, every movement of the stock in that market. The stock price keeps changing. So if the stock price keeps changing, the relationship between the stock and the strike price will change. If my strike price is at 50, I bought a call option, and right now the stock is at 52, my option contract is in the money. An hour later, stock fall down to 49, my option contract is out of money. So it is not constant. The moneyness of option contract will keep changing, and it changes whenever the stock price changes. Now, something that is currently in the money, like I gave an example of the call option, it could become out of money. And it could happen reverse also. Stock could go up from $48 to $52. So it was out of money at 48, and an hour later, it's in the money. So let's look at how it impacts buyers versus sellers. So option buyers, they are happy if the contract is in the money, because the terminology itself is from the perspective of an option buyer, that the contract is making money for the option buyer. So they are happy. The other party of that contract is not happy if the contract is in the money, because they are option seller. Their option contract is not making money for them. Again, the overall portfolio could be different. I'm just right now focused only on that option contract. And if it is out of money, it is reverse. As an option buyer, you're not happy if your option contract expires out of money. But as an option seller, I always want my contracts to stay out of money so that it expire worthless. And I will be able to retain the whole premium that I've received. And I can then again do the same thing. That's a good situation for me if I'm an option seller, is that it should just expire worthless. Okay. Now let's look at the moneyness and the expiration. If it is in the money, then it will be exercised by option buyer. And if you are an option seller, it will be assigned to you. So if in your portfolio, you have options that you have sold, and now those options are in the money, those could be at risk of assignment. Let me say it again. If you have an option contracts that you have sold, and now those are in the money, then you could be at risk of assignment. I'm not making a deterministic statement that you will be assigned, but it will be at a risk of assignment. Now, if it is at expiration on the last day, then you will definitely be assigned. The one question which I get regularly is, I sold a put option at 50, now the stock has fallen down to 48 2 days later. Will I be assigned? May not be. Are you at a risk of assignment? Yes. But would that risk materialize? That depends on a lot of other things, which we will cover later when we discuss, again, after the intrinsic and extrinsic value, we will talk about how to view the risk of assignment. But if it is at expiration, there is no more time left after that, and it expires in the money, then you will definitely be assigned. So keep an eye on those contracts that are nearing expiration and see what you want to do if you don't want to get those exercised. If it is out of money, then those will expire worthless. There will not be any transaction for the buyer or the seller. But for the options that are in the money, option buyer, they will exercise it, because that's the only way for them to capture the profits. The contract is profitable for them because it is in the money. How are they going to capture those profits? they're going to go through an exercise process. They will call up their broker and say, I want to exercise this. In that case, you will be assigned. But if it is out of money, it is not making any money for the option buyers, then he would just let it expire. I mean, it's a worthless paper for them. So they will not go through the process of exercising an option contract, which is not profitable for them. So in that case, there will not be any transaction either for the buyer or the seller. So if you have sold an option, it will expire worthless. At the money, it's a rare, like I said, it's a rare occasion because it means it has to expire, or at expiration, it has to be the same, the stock price should exactly be equal to the strike price. But even in that case, I don't think anyone will go through, there will be any exercise that would happen. So there will not be any transaction for either the buyer or the seller. So takeaways. Moneyness is viewed from the perspective of option buyers, even though we are option seller. But when we are thinking about moneyness, just to get the concept clear into mind, just think about how it makes money for an option buyer. So option buyers want the options to stay in the money. Sellers would want the options to stay out of money. That's it. So any questions on moneyness and how it impacts option buyers or option sellers? Okay, looks like no questions. So let's move on to the next one, which is now we're going to talk about how this exercise and assignment process actually works. Because now we've introduced the concept of exercise, because that's the way in which an option buyer will be able to make use of their right to either sell the shares or to buy the shares. They go through an exercise process, and as an option seller, you will go through an assignment process. So now let's look at what that exercise and assignment and how does that work. All right, so let's look at how the exercise and assignment process will work. And again, this is all with respect to how it works in US. I know there are some folks from India who are joined, so you need to figure out how it works in India. But this is how it works in US. So so for someone who's new, this whole exploration and assignment process is really a mystery. And people don't know. And this is one question that I would say kind of keep people away from option trading is they don't have a clarity on when you can get assigned, how does this process works, am I going to get a call, how exactly it happens. So we're going to talk in detail about it, especially the assignment process, because if you don't understand the basics of the option assignment, which if you're an option seller, you will be could be at a risk of assignment. If you don't understand how that works, it could become a little scary, because then you would see things happening in your portfolio that you did not expect. That is why most of new option traders, they are so scared that they say, you know what, I don't even want to sell options. I will just go ahead and buy options. Because then I know I put in $200 and that's it. Then nothing can be assigned to me. It's only I who will be taking action if I want to exercise or not. Of course, it is easy, but that's not a profitable way of trading options. It's not an optimal way. It's easy way, easy to understand. easy to manage, but may not be easy to make money. So I see a question saying, I did a covered call, the strike price reached, I got assigned. So again, it depends on, let me answer this question first. You got assigned because the extrinsic value in that covered call, probably that is very less. Number two, when you're doing a covered call, we talked about in session 2 that you have to be careful about the dividend. The upcoming dividend will, okay, because we haven't covered option pricing and extrinsic value, but let me say that anyway, because I'm going to talk in detail about risk of expiration after we talk about option pricing, is if the amount of a dividend declared is more than the extrinsic value in your option contract, in your short call, then you will definitely be assigned, even though there are 4 weeks left for option expiration. So that's stuff what could have happened. Or if your option, um, the extrinsic value is extremely low. Those are the two areas in which you could get assigned way early. So keep an eye on dividends or any other corporate actions. But if there is no dividend coming up and is still good amount of extrinsic value left, then you are not at a risk of assignment. Again, I'm saying you are not at a risk of assignment. But someone, an option buyer, who is willing to give away all the premium and want to exercise it right now, then hell, you could get assigned. But that generally doesn't happen. Yeah. All right, so let me take you through how this exactly works, the whole process. So in this session, I want to break down the entire process so that you are clear how the process actually works. Okay. So basic concepts. Options have a finite lifetime. We all know that they will expire on a particular day. After that expiration day, those options cease to exist. And options are regulated by entity called OCC, which is called Options Clearing Corporation. Okay. Now, who is OCC? Till now, we talked about option buyer, option seller. We talked about market makers. We talked about the brokerage firm that we use for trading. Now, behind all this, there's an entity called Options Clearing Corporations. OCC, that's the world's largest derivatives clearing house. It provides services to all the exchanges where options are traded. Now, when you and I trade options, I don't know you personally. You don't know me. So who's the guarantor? Who's going to make sure that whatever is we have agreed upon will both stick to the terms? So that is being enforced by this clearing corporation, OCC, through the brokers. All those brokers are kind of a OCC are regulate. I wouldn't say regulated, but I would say they work with OCC. And they OCC provides services to all the exchanges. We have 20 exchanges where the options can be traded, equity as well as futures. We're not gonna talk about futures options here. We're gonna focus our discussions only on equity or index options. So it acts as a guarantor for all the equity and future options. Because there is OCC, I can still go ahead and sell an option contract or buy an option contract without worrying about will this contract be honored or not. OCC will make sure that the contract will be honored. So if I bought a call and if I want to buy the shares, I want to exercise my call, I will get the shares at my strike price. OCC acts as a guarantor for that. Yeah. Now, minor information, because it deals with equity options as well as future options, it operates under the jurisdiction of SEC as well as Commodity Futures and Trading Corporation, CFTC. Like I said, it guarantees all the trades by acting as a counterparty to all the trades. They are not the other party. I am not buying or selling with OCC. When I buy a contract, I buy it from someone else. I don't even know. It goes through the market makers, and then the market makers will sell it to someone else. But OCC act as a guarantor. It acts as a counterparty. It reduces the counterparty risk that I might have in my trade. Counterparty risk means what if the party on the other side of the contract goes bankrupt? Like, what happens to that? In that case, OCC is there to protect me. It acts as an overseer to ensure that all the parties on both sides of the contract, they will do good on their part of the contract. It is an indirect participant in every option trade. Let's look at how the exercise versus assignment. So we talked about it, that exercise happens when this option buyer decides to exercise its contract, or if it is in the money. At least in United States, we have a concept of auto exercise. So if an option is in the money by at least 1 cent, this exercise will be initiated automatically. But if it is not, and buyer wants to exercise it before expiration, then the buyer will have to initiate it. They will have to call their broker and tell them, I want to exercise it right now. But if at the end of expiration period, if the option contract is in the money by 1 cent, it will be auto exercise. Okay. Yeah, buyers have a right to exercise their option. Assignment means it is assigned to option seller. So at expiration, if you had some option contracts that you have sold and those expired in the money, then those contracts will be assigned. And those will be assigned automatically. In that case, you have an obligation to perform as per whatever the contract you agreed upon. If you sold a put option contract, that means you gave someone else to put the shares to you, means you agree to buy the shares at the strike price. And if you are assigned that option contract, you have to buy the shares at that strike price. Or if you sold a call options, means you gave someone else a right to call the shares from you. And if that option expires in the money, then you will be assigned that option. Then you will have to give away your shares at that strike price. Because as an option seller, we have an obligation. As an option buyer, you have a right whether you want to exercise or you don't want to exercise. But a seller has an obligation. And if assigned, we gotta do our part. And OCC ensures that each of the parties, they do their part. Okay. Yeah, no questions. Let's continue. So when does this expiration happens? As a new option traders, the most important date is 3rd Friday of the contract month. And that's for monthly options. For example, let's look at so let's look at, this is what DoorDash. So monthly options, this is monthly options, is the 3rd Friday, 15th Jan. This is January 15th, 3rd Friday. We got 5 Fridays in January. For February, it is 19th February, which is again the 3rd Friday. 3rd Friday of February. So mostly I'm interested in monthly options. So I keep an eye on the 3rd Friday of every month. If I don't want to go through process of assignment, I have to make sure that I close all my positions, all the options that I've sold before this, so that I don't have to go through process of assignment. After third Friday on that monthly expiration option, I don't have any choice. Stock market is already closed. If I miss that board, I miss it. There are weekly options which expire on Friday every week. For example, DoorDash also has a weekly options. Now this weekly option is expiring on 24th, which is Friday because it is not a working day, so it expires a day before the working day, or the day before Friday. So essentially the last working day. And then it expires on 31st, which is again the first is holiday. But later on, if you look at it, expire 8th because 8th is Friday and it's a working day. So market is open on 8th. So the weekly options will expire on the Friday of the week. But we also have other tickers like SPX, SPY, or VIX, where you have a midweek expiration. Again, if you're not trading in these SPS, XPY, VIX, you don't have to worry about midweek expiration. I generally don't like to trade on the equity options for the weekly options, so I don't have to worry much about it. Most of my trades are on monthly options, the regular month options, and that means I have to be very cautious when I'm entering the third week because that's the expiration week. A question says, have to literally call? No online. Where do you initiate? We'll talk about it. So American versus European options. Now the options can be exercised anytime during the options period. Those are called American options. It has nothing to do with that these are traded on American exchanges or are these traded on European exchanges. It's just the nomenclature is if the option can be exercised anytime during the option period, or option seller can be assigned anytime during the option period, those are called American style options. Then there are European style options. If I am bought an option contract on European style, I cannot exercise it in the middle of expiration period. It can be exercised only on the last day of whenever it expires. So if it is in the money, it will be exercised. If it is not, it will not be exercised. It cannot be exercised before it. I don't worry about much because I don't trade it. Mostly these are index options or Forex. I don't trade in that. So that is why I always say, keep in mind that if you're selling an option, you could be assigned anytime throughout the option expiration period. It's not that you will be assigned only on the last day after the market closes on the last day. You could be assigned anytime. Okay. Let's look at the automatic exercise. I kind of briefly hinted it. For in the money, OCC has a provision for auto exercise. Any option that is more than 1 cent in the money at the it is at the expiration, it will be automatically exercised. If it is in the money before expiration, nothing will happen. In that case, if you want to do it, you will have to go through your broker platform to exercise it. You will have to take an action to exercise it. But if it has the expiration period has already arrived, it's over, and it has expired with 1 cent in the money, then it will be automatically exercised. So if you are holding an option, it means you bought an option and say it is 5 cents in the money. And if you don't want to go through the exercise process, because say your broker charges you $15 to go through the exercise process, and your option contract is just 5 cents in the money, means it is only $5 that it is making for you right now. Why would you want to go through that exercise process? In that case, you'll have to call your broker and tell them, don't exercise my contract, don't let it go through the auto exercise, or you just close the contract. Because if it is expires 1 cent in the money, it will go through auto exercise process, and then you will get $5, but you have to pay $15 or whatever that exercise fee is. Yeah. So let me look at some questions. Have to literally call for exercise? I don't know, because I never had done any option exercise in all my years of option trading. Depending, I didn't even check on TD Ameritrade if it is I can right click and say exercise or not. So yeah, I don't have an answer to it. It's a good question. Do you have to literally call to exercise it? I know for sure if you call the trade desk, they will do it for you. But does your broker platform provides an online way to exercise it? I don't know. Uh, it could be or it may not be. I don't have any experience in taking my option contract through assignment process. So I have never gone through the process. Okay, so let's look at how the overall assignment process works, right? People have this notion that they are trading with one other particular party. For example, if I sold an option contract to person A, then I could be assigned only if that person A decided to exercise it. That's not how it works. So here I want to talk in detail around how the overall assignment process works for a long call, means you actually bought a call. But before that, let me sip some water. Any questions, do let me know. Okay, no questions. So let's talk about how the overall assignment process works. We've taken an example of a long call. Means someone who is holding a call option is a call holder. He bought a call option and he wants to now exercise it. Say it is not an expiration at the end of expiration, because if it is at the end of expiration and it is 1 cent in the money, it will go through auto exercise process. But I want to exercise it before the expiration period. Expiration could be 2 weeks away. I want to exercise it right now because there's a dividend coming up. If I exercise it right now, I get the shares in my portfolio, then I can capture the dividend. So what, as a call holder, what they'll do is send a notice to their broker. And there was a question, have to literally call or online, whichever way works for your broker. That call holder will either call their broker or do whatever needs to be done online to initiate the exercise process. So essentially telling his broker, I want to exercise this call option that I bought. So broker will send a notice to OCC saying, I got a person who's holding this call option contract. Now he wants to exercise it. OCC will say, fine. OCC will select a member firm. Like I said, all the brokerage firms, they are kind of a part of this over consortium. So OCC will randomly select anyone and tell them, we got a short call. We got someone who wants to exercise their call, and you have someone who have sold an option at the same strike price for the same expiration period, and basically they will assign it to the other broker firm. So say if this person is dealing with Fidelity OCC could send this to TD Ameritrade and say, okay, we got someone who wants to we got a notice that someone wants to exercise their call option at a $50 strike price for XYZ expiring January 15th. And you have someone who actually sold a call option for XYZ stock at 50 strike price expiring January 15th. So they'll send a notice to the other broker firm. Now the broker firm may have hundred or thousands of customers who would have sold that call option. So they will randomly pick up someone, or on first in, first out. We don't know what the process is. And then they will assign the contract to the call writer. So if, say, you were doing a covered call, means you have a shares and you sold the call. And I also did the same thing. I have the shares, I sold the covered call. We both did, because we were chatting on Slack. And I say, maybe $50 is a good enough strike price to sell a call on this. Let's do a covered call. You did the covered call, I did the covered call. Someone asked and they exercised their option to call the shares. You are with Fidelity, you got assigned. I probably didn't get assigned because the process is random. So it happens that in some cases you might get assigned a day earlier, I might get assigned a day later. It's being picked up randomly. The brokerage firm will be picked up, generally gets picked up randomly. And then within the brokerage firm, depending on what the process they are they using FIFO, or they're picking randomly and assigning it to whoever has, if there is anyone who has sold that call option, they could just assign it to them. So you would see that in some cases, I might send a note saying, I got assigned, this option was assigned to me. In case if you've been assigned, you can do these steps, but in case not, then you may be at a risk of assignment. You probably still have a little more time to take a corrective actions. So in any case, once the brokerage firm assigns this, so then whatever action needs to be done, it will happen. In the case of covered call, then the brokerage will take the shares out from my account because I sold the call, and then basically give it to OCC. OCC makes sure the share gets transferred over to the call holder. So the process is actually random. And that's the reason why you would see, get into scenarios wherein some people get assigned and some people may not get assigned at the same day. So because it's a little random process. And again, it also demonstrates that it's not that if you're sold, when you sold an option and Joe bought it, and then only Joe, when they exercise, you will be assigned an option. No. Anyone having the same strike price, same expiration period, same ticker symbol, if anyone exercise that and you have sold one of that option, you could get assigned. All right, any question on assignment process? All right, let's move on. So let's talk about the settlement. So once this whole assignment happens, then how the settlement works. So there are two types of settlements. One is called physical settlement, which is generally what we will be dealing with. It means you have to actually deliver the underlying equity. For example, if you sold covered call and the option expires in the money, then you will be assigned. Then you have to deliver those shares. So most the trades that we do are physically settled because we generally trade in equity options. Means I have a Facebook shares, Apple shares, Amazon shares, those are all equity options. If it gets assigned, I have to deliver the shares. Or if I've sold a put option and if that put option get assigned, then those shares will come in my portfolio. So suddenly I will see 100 shares of, if I sold a put option on Dash, and if that get assigned to me, I will see in my portfolio 100 shares of Dash, because those are physically settled. The other settlement is cash. In that case, there is no movement of shares or underlying. It's only the amount of cash moves in or out based on whether it's profitable, it expires for you profitably, or not. Because in that case, you cannot deliver the underlying security, right? SPX is an index. There is nothing beneath SPX. There is no shares for XPX. So mostly the stock indices those are called cash settled. So in that case, the broker will just update your account balance on expiration based on how much profit or how much loss you made while trading these cash settled indices. So for example, if I if I had sold an SPX option at a strike price of 3,700, and at expiration, the SPX is now trading at 3,690, 3,690. Now, after expiration, because now this is in the money, I sold a put option. Now the stock has fallen below the strike price. SPX is below 3,700. So I will be assigned. So then after expiration on Sunday or Monday, if I open my trading platform, I will not see 100 SPX units. What I will see is my account balance has been reduced by $1,000. 1,000 because the strike price was 3,700. SPX closed at 3,690. So I kind of lost $10, and 100 underlying, one contract underlying has 100 underlines of SPX, and hence $1,000. So just my account balance will change. But instead of XPX, if it was FB, then on Monday I will see 100 shares of FB in my portfolio, because most equity options, they are physically settled. You will have the shares in your portfolio. Index options are not. I generally don't deal in index options, right? Because these are the larger contracts. So I don't worry about much for these right now. Next question. When it generally get exercised or assigned? It could happen anytime during the option expiration period. But most of the time it happens during the week of expiration. Now there are exceptions that we'll talk about. But generally I don't see it happening, 3 or 4 weeks before expiration, even though the stock has gone in the money. Most of the time the exercise will happen during the week of expiration. Because if you're exercising it earlier, and the assignment process is initiated because the buyer wants to exercise it. And whenever buyer exercises it, it loses the extrinsic value that still remained in the contract. And that's the reason I don't want to dig deeper into this. So until the extrinsic value is very small, there's little chance of option being exercised. Or if there is a other driver like the dividend, which they can capture, is more than the extrinsic value which they will lose, then there is a risk of assignment. Otherwise, most of the time, you probably will get exercised in the week of expiration. So what to do if you're assigned? You sold an option and you forgot to close the trade before expiration, you got assigned. So if your portfolio can and you want to hold the position, hold it. Maybe you sold a put option because you wanted to acquire the shares, right? Cash secured put. Now the share has gone below your strike price at expiration, you got assigned. That's what your purpose was. Hold it, no problem. That's what I wanted to do. I wanted to get the shares at that price. I got it at that price. And I also got some premium when I sold it. So I have no issues. My portfolio can hold those shares. And I want to own those shares, then I'll own it. I'll hold that position. Then you should see if you want to implement any risk reduction strategies, right? So you got the shares if you sold a put. You want to do a covered call? Again, these are the decisions then you can take once you have those stock in your portfolio. Or if you sold a covered call and the shares had been called away from you, do you want to wheel it? Do you want to sell another cash secured put? Because now you got the money coming into your account. Shares were got called away from you, you received the money. What do you want to do with the money? But if you don't want to hold the position, right? So for example, in the cash secured put, you sold a put, you've been assigned, your mind changes. Oh, I don't want to have these shares. Okay, sell the shares in the market. That's it. Nothing worse could happen. So when you're getting closer to expiration, evaluate your options, contracts, or evaluate your trades and see if I get assigned on this one, is it okay? Am I okay with it? Is my portfolio okay with it? If you have doubts, maybe you want to close your option trade before you can get assigned so that you don't go through this whole assignment process. What if your portfolio can't hold the position? And again, this probably will not be applicable for those who have level 1 or level 2 privileges only, but those who can sell naked calls and naked uh, puts, they might get into a position where your portfolio cannot hold the assignment. So if you are just starting and only thing you can do is to sell a cash secured put or sell a covered call, then this slide is not applicable. But I know there are many who can do naked puts and who can do naked calls. So for them, what if your portfolio can't hold that assignment? So for example, say you sold a put, it was a naked put, means it was not backed by the amount of a cash that you have in your portfolio. And you got assigned that put. And your portfolio is not big enough. Say you sold 5 contracts of Amazon, just for fun. Amazon is a big ticker, right? So you get a sticker shock. So one contract of Amazon, notional value is 300, wherever Amazon is. Say it's at $3,000. So one contract of Amazon, if you have sold a put on it and you have to buy 100 shares of Amazon, it will be $300,000. You should have $300,000. Even if you're on a margin, say you have to put up 25%, you still need to have $75,000. You sold 5 contracts, you either have $1.5 million in your portfolio, or if you're on a margin, equivalent amount. But if you don't have that much amount, and this contract expired in the money, you were busy, you didn't look at your positions, you didn't close it, what will happen? In that case, you will receive the dreaded margin call from your broker. And these are the 2 words. When I was starting on my options journey and I was chatting with my friends saying, I want to get some control on my financial life, and I don't want to depend on market going up and down and like an ECG. And My heart is pumping like an ECG. So I want to learn options, and I'm starting to do options. Everyone warned me that options have ruined people's life and their portfolio because of margin calls. Oh, those are all my good friends. I'm still friends with them. And then I started answering what's the margin call, how it works. It works because if you're not careful and about your position sizing, and you've gone too big without realizing the risk, you'll get a margin call from your broker. So most brokers will provide you some time to come up with funds. Say an example of Amazon. Now you suddenly need to come up with $200,000. Brokers will give you some time. I think it's 24 hours is what I heard. Most of the brokers will give you. If not, they will liquidate your positions. A broker's not going to take any risk. If you can't add the funds, they will sell your stocks or whatever they can get their hands on. They will sell it so that they can get the funds for this position. So the best is, first of all, don't even take those risks. Or if you've taken it, just close the option trade up front. Don't go through this. Or if you want to go through this, make sure you have sufficient funds. And in my years of option trading, I never received a margin call because again, my motto is risk before rewards. So I'm always aware of how much risk am I taking, what's the position size, and you'll hear me saying this again and again and again and again ad nauseum. However exciting, however profitable any trade might look like, one thing which you should never violate is position sizing. And I'll talk about position sizing rule when we look at an entry criteria checklist for entering into a trade. Because there are umpteenth number of stories that I have heard and I've read. And those are the stories that give a bad names to options trading, is when people get too big and they get margin calls, which they cannot manage. And then they go bankrupt because now they lose more than what they have. It happens only if you are not taking care of your risk. But if you're aware of your risk, don't trade too big, don't become too greedy, I'll never get a margin call. So because I didn't have a personal experience, and this time when the markets fell down on March 23rd, I got a little conscious saying, how does this process work? So I asked one of my friends who's a full-time trader, and I asked him, like, how does margin call work? Do they really send an email? Should I keep an eye on my email, or what would happen? And he told me, no, they will literally call you on your phone. They'll call you on the number that you're given. The trade desk will call you if they need more margin account from you. I'm like, okay, yeah, but nothing happened on my portfolio. But I was getting little. I just wanted to know how this works because the market fell down 30%. But my portfolio was still, like I told you, I keep risk before rewards, so it was still okay. But in this case, they will literally call you. You will receive a phone call from your broker that you need to put in more margin money. So make sure you're aware of and trade accordingly, because there are more horror stories around the margin call than I can cover in 2-hour sessions. And anytime I dig into those horror stories, the number one reason I find is too big a position size. They've gone too big. I never violate the position size rule, and that's worked out good for me over the years. I don't care how profitable the trade might look like. So options can be exercised or can get assigned anytime. Most of the time this surprise new traders, because the general idea is Hey, my option, I still have expiration period is, excuse me, expiration is on Jan 15th. It's okay. But like I said, it can be exercised and assigned anytime. That doesn't mean that it will happen. So there are ways to figure out, is my option trade at risk of assignment or not? We'll talk about that in subsequent sessions after we cover the option pricing. However, most of the times it happens in the last week, but exceptions do exist. So keep an eye on extrinsic value. If you already know how to find that in your broker platform, go ahead. If you're not, then we'll talk about, if on your broker platform doesn't say extrinsic value, how to kind of deduce it. We'll talk about in subsequent sessions. Check if your portfolio can hold the position if assigned. Otherwise, implement the reverse transaction. If you've been given the shares, you can come up with the funds to hold the shares. Oh, sell the shares in the market. You may have to take some loss if the shares have fallen below your strike price, but it's a part of a game. Or if it has gone higher, or maybe you made some money. So if you can't hold it, reverse the transaction. Or the best is to close a position sooner to avoid monitoring or hassle of assignment process. So we will talk about closing the positions, what's our trade exit checklist, when to close the positions. Should we wait until the last week of expiration? Most of the time, I try to get out before the last week of expiration on most of my positions. I mean, there are some stragglers which always remain, but I try to get out of it before the last week of expiration. Okay. All right, so that brings us to the end of today's session. If you have any further questions, feel free to email me, and I'll be happy to respond to you. If you want to view the recordings, it's available on the website, and you can go and see the previous recordings. The today's session's recording will be uploaded by latest by Thursday. And I will send a note to all those who had RSVP'd to this on Meetup that the recording is available. So then you'll know that it's up on the website.